Welcome, everyone. We are going to go ahead and get started, 7 o'clock. We're going to do this a little differently with Chapter 9. What we're going to do with Chapter 9 is, let me check my mute to see what's going on, because I don't seem to be seeing any signal coming through. I'm going to test and pause this recording a minute. Okay, we're back. So I'm going to do this a little differently with Chapter 9 because some of the problems are lengthy in filling them out. And I want to make sure you capture enough information. So you're going to be looking at the answers for the practice problems, but your data will be different with your homework. So just keep that in mind. If you're trying to take a shortcut, it won't work on this. So we'll start with question number 1. As you can see, you have to identify what items are normally classified as current liabilities, and that has a 1 year or less operating cycle. So as you can see, the only two that don't fit are the note payable in 2 years and the note payable due in 18 months. All the rest are due in less than a year. That's not one of the ones I was talking about. In this one, liabilities of organic foods are made up of $60,000 in notes payable. So those notes, $3,000 due within the next year. So when you go and put them on the balance sheet, you're going to have to go ahead and first list current portion of long-term debt, and then you'll, under current long-term liabilities, put notes payable. You're going to subtract the $3,000 in current liabilities from the $60,000. That's what's going to go on the first line. And second line under notes payable. If you subtract the 3,000, it's 57. Okay, we're back again. Moving on to question number 3. Here we're going to have to account for sales taxes and journal entries. So the first thing we're going to do is record the sale itself. Extra computing sales merchandise for $6,000. Gives us the cost of the merchandise, which is $3,900, tells us what the sales tax is. You'll have to multiply the $6,000 times 1.05 to get the gross, and that gross in cash is $6,300. So you have the $6,000 sale, you have the $300 in sales tax. So we know what our debit is, $6,300 in cash. Our credit's going to be $6,000 in sales and $300 in sales tax payable. Now, the next entry, you should know well by now, we have to record the cost of goods sold. So we're going to do a debit the cost of goods sold for $3,900 and a credit to merchandise inventory for $3,900. And then finally, when we pay the sales tax in next month, we're going to debit sales tax payable to remove that liability. And we're going to credit $300 in cash, which is the amount we're going to send to the government. All right, in this one, we have advanced ticket sales for Bon Jovi. And the advanced ticket sales were $5 million. So on the day that it was recorded, October 31st, we're going to do a debit to cash for $5 million and a credit to unearned ticket revenue. Now he's got 4 concerts. So we're going to divide that that $5 million by 4. We are going to debit unearned ticket revenue when we have that first concert on November 5th for $1.25 million. And then we're going to credit ticket revenue for $1,250,000. And each time we have a concert, we'll debit and credit the same amount accordingly. Okay. On problem number 5, you have requirement 1 and then requirement 2 and 3. So on November 7th, Mirror Company borrows $160,000 cash by signing a 90-day 8%, $160,000 note payable. Now, what makes this easy? Well, I take that back. On this one, it's not so easy. This is going to be divided up between the current year and next year. So we have to break it up to know how much interest is going to be charged this year and how much is going to be charged next year. So that's requirement one. So you're going to multiply in each one 160,000 times 8%. But then in the first one, we're going to do 90 divided by 360 because that's telling us the total amount of interest we have to pay. Next, 160 times 8%. Remember our banker rule? 54 divided by 360. We have 54 days left in the current year. And so that tells us what we're going to have to capture this year. And then finally, we have to determine what the interest will be next year. It's 160,000 times 8% times 36 over 360. And that gives us, in this case, 1280. Now, we have to do the journal entry. So to capture the interest expense this year, we're going to debit interest expense on that first amount we calculated for 54 days, and that's $1,920. And we're going to credit interest payable, $1,920. Why is it a payable? Well, we're not going to hand over the cash until the note is due, and that won't be until February 5th. So when we go to pay off the note, we have to first put the interest expense for next year of 1280. Then we put the interest payable that we recorded in the year we took out the note, which is 1920. We're going to put the note payable itself of 160,000. These are all going to be debit. And finally, we're going to credit cash for the total amount of interest plus the total of the note, 163,200. All right, now we're going to get into payroll. Now, before we get in the next couple of problems, you need to understand something. There are two components to payroll. There is the employee side, which is where you pay them their salary and then take out their deductions. All right. Then you have the employer side. Most employees don't realize that the employer has to pay taxes based on what your salary is. Okay, so there's two types of taxes: what the employee has to pay and what the employer has to pay. The first part is what the employee has deducted out of their paycheck. So we're looking here at a gross pay of $4,000. Then we have to calculate the FICA Social Security, the FICA Medicare. You can see that those rates are given to you in the problem. So you're going to take to figure the FICA Social Security 6.2% times 4,000. FICA Medicare is 1.45% times the 4,000. And then the rest are all given. Income taxes are given at $500. Medical insurance deduction, $160, and life insurance deduction, $10. Add all those up and subtract them, or add all those up comes to $976, and you subtract that from the 4,000, and that gives us net pay of $3,024. Next, we're going to have to do journal entries. Okay, so in this example, North Company's employees earn $35,000 sales salary, and it gives us the withholdings of 6.2%, 1.45%. We know now you have to multiply the salary expense times those rates to come up with your two different FICA expenses. All right. And then you're going to, let's see, we have $6,500 of federal income taxes withheld, $772.50 of medical insurance, $120 of dues. Now, we're not going to write these checks right away. So all these amounts you see up there, they're all payable. Even what's left over, salaries payable, which you notice is last on the list. There's a reason for that. All right, they're all going to sit as liabilities until you actually write the check. Because as all of you should know, if you're working, you never get your check on the last day of the pay period. All right, you usually have to wait a week or two. That money has to sit there in a payable account until it's paid out. So you're going to start off with a debit salary expense of $35,000. So that's what the actual expense is here with your employees. All right. Then you're going to do all the payables and down to union dues. And what I like to do, the reason why you do salaries payable last, you add up all those payables from Social Security down to union dues, come up with a total and subtract it from the salary expense. And that's going to be what's left over that you're going to write the check for to the employee, which in this case is $24,930. Now, the employers have a responsibility, and it's called payroll taxes. All right, this is a business expense. They have to match whatever Social Security and Medicare was withheld from their employee. So in our example, we have 10 employees, each of whom earns $2,000 a month and has been employed since January 1st. And then it gives us Social Security taxes of 6.2% of the first 137.7. Then FICA, which is 1.45%, and that's unlimited. There's no cap on that, as I explained in my lecture video. Then you have federal unemployment tax called FUTA and state unemployment tax called SUTA. And so federal unemployment tax is 0.6% of whatever's paid on the first 7,000. SUTA is 5.4% on the first 7,000. So as you can see here, if you take 10 times 2,000, that's $20,000. Okay, you need to calculate that first. Then you're going to run all of your calculations. Multiply that 20,000 times 6.2% times 1.5%, et cetera, et cetera. All right, you're given the rates up here. So after you calculate your total payroll, notice nowhere in the problem does it give you total payroll. You have to know to multiply 10 times 2,000 to come up with your monthly payroll, so you can calculate what your payroll taxes are. So again, I'll repeat, you're going to come up with $20,000 in total payroll expense, which is 10 employees times 2,000 a month. Then what you're going to do is you're going to multiply that times 6.2%, which is 1,240. Then you're going to multiply that times 1.45%, which is 290. Then you're going to multiply it times, and it's the SUTA rate first of 5.4%, which comes to 1080. And then finally, federal unemployment tax, which is 0.6% or $120. Now, as my video for this chapter talked about, is when you're dealing with warranties are handled in a special way when it comes to expensing them. There's something called a warranty expense. And so let's look at our first example here. December 1st sells a mower that costs $200 for $500 cash. So what are we going to do? We're going to record the sale first, debit the cash, credit the sale. Then we have to, remove it from inventory. So that's debit the cost of goods sold for $200 and a credit to merchandise inventory for $200. January 24th, they bring it in for warranty repairs. So what you're going to do in warranty repairs, let's see. Oh, wait a minute. I got to stop here a minute. We have to first record the warranty expense based on the sale of the mower on December 31st. I skipped that. So it's estimated that our warranty expense is going to be 8% of sales. So we multiply 8% times the $500. That's going to be a debit to warranty expense and a credit to estimated warranty liability. Next, when it comes in for repair on January 24th, we're going to do a debit to estimated warranty liability, and we're going to do a credit to parts inventory. Okay. that's how you'll work through these transactions. So first you have the sale. End of the year, you got to capture the warranty expense, just like we do for bad debt. All right. And then you're going to, on January 24th, actually record when someone uses that warranty and record it in the general journal accordingly. Okay. Next, accounting for contingent liability. So the first one, Humphrey can reasonably estimate that pending lawsuit will result in damages of $1.25 million. It's probable he will lose the case. So you're going to record this as a liability. Okay. Next, so what it will be a lawsuit payable, I guess. I don't know. It's reasonably possible that Humphrey will lose a pending lawsuit, but the loss can't be estimated. Well, that's going to be the closing in the notes to the financial statement. And finally, Humphrey is being sued for damages of $2 million. Very unlikely that he will lose the case. You don't have any responsibility to disclose it. All right, on the next one, you're going to show the current liabilities on the balance sheet. All right, and this should be pretty straightforward because let's see if there's any, let's see, out of what I'm looking at here, out of all these, current portion of long-term debt will go under long-term liabilities. Don't see any, note payable due in 4 years. That will go under long-term liabilities. And, well, they have current portion, current meaning less than a year, I'm sorry. What I told you first, the current portion of long-term debt will go under current liabilities, okay? Keyword was current, I should have picked up on that. All right, so 9 of these will go under current liabilities, and the one note payable due in 4 years will go under long-term debt. Here you have to put where each one's going to go in the liability section. That's fairly straightforward for you to work, so I'm not going to spend any time on it. Okay. Let's see what we have to do here. On July 15th, Piper Company sold $10,000 of merchandise, cost them $5,000. Sales tax was 4%. And then we had to do a transaction where they sent it to the government. So same one that we looked at earlier. You're going to debit cash, 10,000 plus whatever the sales tax was. So I think it was $400. So it's 10,400. Then you're going to credit sales for 10,000 and credit sales tax payable for $400. Then you're going to do your cost of goods sold transaction, debiting cost of goods sold 5,000, crediting merchandise inventory 5,000, and that will complete your journal entries there. Next, on November 3rd, Milwaukee Bucks sold a 6-game pack of advance tickets for $300. So we know that's going to be $50 a piece, right? 300 divided by 6. When they played the first game, let's see, Bucks played the first game of 6-game pack. This represented 1/6 of their advance sales. So you're going to debit under revenue $50, and you're going to credit sales $50. See if there's anything else that we're looking for in that. We had to have recorded when the tickets were sold, which I missed, and that was a debit to cash of $300 and a credit to unearned ticket revenue of $300. We had to set up the sale on that one. All right, next, Sylvester Systems borrows $110,000 cash on May 15th on a 60-day 12%, $110,000 note. What date does this note mature? And so that's pretty straightforward. You just count out 60 days from May 15th. Prepare the entry to record the issuance of the note, and then complete the table to calculate the interest expense at maturity. So we go on to 2A. That's pretty straightforward. You know, it's going to be debit cash, credit to notes payable. Then you're going to have to take the number of days divided by 360, multiply that times the principal and then the rate, and that comes up with $2,200. And then when the note matures, you're going to debit interest expense, $2,200. Notes payable, $110,000. That gets rid of the note on your books. And you're going to credit cash, $112,200. All right, next. Similar problem. I'll let you guys work it. Not much different. All right, on this one, table looks a little bit overwhelming, but it's really not. You're going to list the employees, then you're going to list what their cumulative pay is during the year. You're going to next list what's subject to Social Security, because remember it capped out at 137.7, as we see here for Julie W, Zach R, and Christina X. Then pay subject to Medicare, which is going to be everything because there is no cap on Medicare. It goes into infinity. And so what you're going to have to do is, that doesn't require any calculation check. Then we have the pay subject to FUTA, which you see here, and remember it capped at 7, same thing for SUTA, okay? Under requirement B, here you're going to have to calculate, looks like payroll taxes, yeah. So you're going to take the total tax paid by the employee, all right? And you're going to get that from your first column. I'm sorry, your pay subject to FICA. That's where you're going to get that from, all right? And then tax paid by the employer, those are the payroll taxes. And these two should equal, because remember I said the employer has to match what's deducted from the employee's check for each of these. Now, when you get down to FUTA and SUTA, you're going to have to look at the tables and multiply it times the both rates, which are, it's easy in this case, it's 59,000 for both. So you'll multiply 59,000 times 0.6 and 59,000 times 5.4%. Okay. For each separate situation, indicate whether a cruise company should record a liability, disclose the notes, or have no disclosure. In the first one, where a cruise company guarantees $100,000 of a debt to a supplier, it's probable that the supplier will not default. You'll disclose it in the notes. The reason why you won't put it in the financials themselves is because it's a guarantee doesn't mean that it goes on your books. All it means is you apply the signature that will hold you liable if he defaults. Now, it will go on his books, all right, and it'll go on as a long-term liability, but it won't go on your books. But you'd have to still tell investors, hey, I'm guaranteeing debt on people that, aren't part of our business. Disgruntled employee suing cruise company, legal advisors believe the company will likely need to pay, but they don't know how much. And if you can't determine how much, you can't make it a liability, so you have to disclose it in the notes. January 8th, the end of the first weekly pay period, reached company's employees earned $22,760 of office salaries, $65,840 of sales salaries. Now, it's important because we're going to list both separately on the income statement. That's why they broke it out separately, all right? But as we're going to see, when we calculate all these deductions, we're going to put those two amounts together. So withholdings from the employee's salaries, again, gives you the rates, tells you what the total deductions are, right? Federal income tax, medical, and union. So in the first one, we're going to calculate below the amounts for each of the 4 taxes of Regis Company, all right? So here, so as we can see here, it's the 2 salaries combined, sales and office, and that comes to $88,600, and that's going to be the same that are going to be subject to tax for all 4 of these. You can see the rates are plugged in here. You multiply the rate times the total amount of earnings, and you get your tax amount. Okay. On the next one, you're going to have to do a journal entry. Now, here's where you got to break it up. Here, you're not going to put $88,600. You're going to break it up between office and salaries expense, but you're going to put in our payables of Social Security, Medicare, income tax, medical insurance, and union dues. And that's going to give us our salaries payable after you subtract all these amounts from the $88,600. That comes to $66,782. Finally, now that's the employee side. And all those withholdings, what they are, their withholdings, are going to go into the payable accounts until we write the check to the government. Now, on the employer side, you can see that these amounts, these first 2 amounts, are going to match what we have over here for Social Security and Medicare, because the employer pays the same rate that they have to pay for each employee as the employees have deducted from their paychecks. All right, and again, these are going to go into the payable accounts. I'll explain that in a second, Katie. Then you have your federal unemployment tax, the state unemployment tax, and you can see here the state again is listed first because it's the bigger amount, I guess, and it really doesn't matter in a journal entry. The main thing is that these 2 columns balance. But here you're going to take the $88,600, multiply them times the unemployment tax rates for Fed and state. Now, the reason why these 2 FICA payables are all, whether it be employer or employer, are going to go into the same account, because every quarter the employer has to fill out a form 941 and file it with the IRS, and it combines Social Security and Medicare that are owed to the government. It does not break out what was withheld from the employees and what the employer side is paying. The rates listed there are the combined rates. And I can't remember 2.9 for Medicare and 12 point something for Social Security. I can't remember exactly. So, but anyway, so that's why you see the withholding from the employees and the part that the employer has to pay all going into the same payable account, because that check's going to be written to the government at the end of the quarter on the same form. And if you're taking payroll accounting, you'll learn all that. All right, this one's a little lengthy to get into, but here's what my advice is going to be. 1 transaction at a time, okay? Be very careful when you move from one journal entry to the other, and that's what these are going to be, journal entries. And here, I'll let you take a snapshot of it if you want to see how it plays out. But these aren't going to be the same numbers now, right? Just keep that in mind. So if you plug in the same numbers, you're going to get them all wrong. So again, take it 1 step at a time. I think the cost of the razors doesn't change, if I remember right. But what gets convoluted is you're going to be doing a sale, and then you're going to be having to record the warranty, and then you're going to have to record the return under warranty. It gets confusing. So, and that's why I'm not going through it, because it takes us an hour to step through it in explaining it. So just take it 1 step at a time. you'll do fine with it. The key here is to keep it all straight, okay? By now, you should know what to do in each transaction. It's just a matter of keeping the number of units and the amounts in their proper order. Let's see. On this one, this is another payroll problem. Let's see. Company paid cash to Lynn Addy for 8 days work at $125 per day, which comes to $1,000. Company sold merchandise with a $2,002 cost for $2,800 on credit. Okay, I don't know why we're going back with this again, but in fact, I don't even think. Yeah, there is requirement number 4 shows you got to record the entries for merchandise sold with a 4%. There you go, 4% tax rate. They want to see how you capture the tax. All right, so let's see. The first one's easy. You just have to add up all the deductions and subtract it from the $1,000, and that's going to give you her net pay of $764.50. Okay. The only thing you're going to have to do is you're going to have to multiply the 2 FICA rates times $1,000 to come up with the Social Security and Medicare that's withheld. Then you're going to have to put them in journal entry, and you can see here how the journal entry plays out. Same thing we've been doing all along. This is the employer side. All right, so you should be knowledgeable on how to do that by now. And then finally, recording the sales transaction and showing how you record it with the sales tax payable. All right, that's all I have for tonight. I am going to make sure this gets posted. If you have any questions, you know where to reach me by email. After tonight, we only have 2 more sessions left where we do chapter 10 and chapter 11. And I will make sure I get those 2 lectures posted as soon as possible in case you want to get ahead. For those that are listening to this video, we're going to have a lot of time in November to finish up the unit. So think about if you might want to go back and get caught up on some work you might have missed. I will limit you to an amount of time that will not go into finals. If you want to get caught up the day before finals start, that's it. Really, 2 days before finals start, I don't reopen any assignments. So just keep that in mind for the rest of the semester. Stay caught up, get ahead. That way everything can go smooth. And I see we have someone who joined us. So, Dimitri, do you have any questions before I end the call?
Yes, I was just I heard you talking about making up work. I haven't missed any work, but last night I didn't do well on my homework assignment just because I was rushing and I had a lot of more assignments to do.
Okay.
Is it possible, since I only used 1 attempt, can I go back and do another attempt on that?
Sure. Yeah. Send me an email and
Okay.
and I'll get with you on reopening it for you. Okay. Just the homework.
Okay. Yeah, just well, if I could do the quiz too.
Did you do your second attempt on the quiz?
No, I just did 1 attempt on both.
Okay, then I'll go ahead and extend both for you.
Thank you so much. I really appreciate that.
You're welcome. All right. Have a good night.
Bye-bye.
Bye-bye.